The economy is a little shaky, but you want a stable retirement plan. How do you get there? I'm Erik Brenner. We'll have some answers next on Your Wealth Health. Good morning and welcome to Your Wealth Health. I'm Erik Brenner, owner of Hilltop Wealth Solutions. If you're watching us on Facebook, please share us with someone, and thanks for watching on yourwealthhealth.com. With me today, I have Matt Aurenz, a private wealth advisor and our director of wealth management with the firm, and we are continuing to practice social distancing, so he's well over on my right. And what we want to start off with today is talking about the country's economy and the situation that we're in. We have now entered into our third quarter, believe it or not, and second quarter results are coming out. And so we just wanted to share, Matt, kind of some of the highlights that's happened here over the last couple of months.
Yeah, great, Erik. So if we take a look at the graphic, some highlights from the last quarter, if you will. Basically, we had about 4.8 million people going back to work in the month of June. We had businesses starting to reopen. Consumer confidence was really starting to take a boost. It was up around 12% or so. And we even had things like professional sports starting to get back into play with the NBA and Major League Baseball. So there was a lot of positives in a tough environment, but things were beginning to be pretty encouraging.
So, boy, how things change rapidly, Matt. Now we're seeing more COVID-19 cases jump, certainly putting a stress on our healthcare system. We're seeing unemployment now increase. We're seeing businesses starting to struggle, and there's obviously been more restrictions overall on how businesses can operate. So some challenges, as we have thought all along, some continued challenges along the way, Matt.
Right, exactly. And I think, it's one of those things that for us, things can get a little comfortable sometimes. There's a lot of news out there. And we just can't, we can't just sit back and wait for things to get better. But what we're finding is that if people are aware of the situation and begin to kind of tackle in their own financial picture things they can control and not control, that's really helping them begin to plan forward for the next 6 months, couple years, 5 years down the road.
So, with the CARES Act that was passed back in late March to help with the overall challenges that we were going to have, one of the things was the unemployment benefits. So they had offered an additional up to $600 per filee. And Matt, it's not long that is going to end if we don't hear something from Congress.
Correct. So Congress should get in session later this month, and hopefully that will help tackle some of the potential problems that we see down the road. There was about 51 million people or so who filed for that special unemployment benefit with all the layoffs and furloughs that took place, businesses shutting down. And with that scheduled to end here at the end of the month in July, that creates a lot of uncertainty that just many people will they get called back to work? Will they be prolonged unemployed? And when those special or increased bonus of unemployment benefits run out, if people aren't getting called back to work, that's going to create some additional financial turbulence with people making mortgage payment, car payments, and just general living expenses.
So I think the other challenge that is out there is many people right now are making as much or more on their unemployment benefits.
Right, it was about half the people who were receiving unemployment benefits were actually making more while unemployed than they were while working. And so that creates just a cash flow difference, a lifestyle that people kind of got accustomed to. And good news, we saw early numbers suggested that savings rates ended up increasing up about 30% or so, which is a good thing. So those extra dollars that people were receiving, they were stewarding that money well, they were saving it. And I think a lot of those people just realized that eventually this benefit will run out, and if I'm not back to work, I better have a little bit of a cash reserve to get me through that unexpected certainty.
So if we transition with this and with all the challenges, one of the things, Matt, we've heard a lot about is bankruptcies. We've had several big names go out And we've just got a few of them up here on the screen, which includes Art Van Furniture, Neiman Marcus, J.C. Penney, Brooks Brothers. Many of these have local presence in our Michiana area. Also our local economy has been hit hard. If you're from the Michiana viewing area, you know that Elkhart County unemployment was up to about 28%. St. Joe County was 20%. But we're also saying that bankruptcy is not a lot of times the end of it all. And so let's talk about what are the different types of bankruptcies and how they relate back to the economy.
I think the two primary bankruptcies that we hear about are Chapter 7 and Chapter 13. And oftentimes when you hear of a company going bankrupt, you just assume that's it, they're out of business, they're of no more. But that's really not the case. Most of the bankruptcies that we're seeing right now are predominantly retail, which is to be expected, especially if people can't get out and spend money. And so many of the names that you referenced, Eric, furniture, clothing stores, that type of thing, they're struggling without consumers. And so when they're going into a Chapter 13 bankruptcy, a Chapter 11 bankruptcy, what we're seeing is they're actually just looking to restructure their debt. So they realize they're in trouble. They're reaching out to their creditors and their lenders, and they're saying, hey, what's this going to take for us to restructure our payment plan with you? How can we renegotiate our terms so that we can still operate in our business but pay you back? We just can't afford the existing payments. So what does that look like? And that's the route that most companies will go to basically prolong the expectancy of the business, the solvency of it. And once they get to the point where they say that's not working anymore, they'll then move on to a Chapter 7. And a Chapter 7 is going to be much more stringent. You're going to have some type of trustee or an overseer who is essentially liquidating the assets. So they're going to pool up all of the resources, all of the assets that firm has, capital, financial capital, and they're going to say, okay, who are the creditors, who are the lenders that we need to pay first? And they're going to go down a pecking order. They're going to either sell off assets or just pull money out of the bank, and they're beginning to pay off those lenders. But at that point, traditionally, you're going to see that business is no longer going to exist. If they're a publicly traded company, oftentimes the shares of that company do disappear, and people do lose their money. So again, most companies are going to prolong that Chapter 7 filing as long as possible to try to continue the continuity of the business long term.
So with all of that, how do we explain the stock market and how it has performed of late?
I think the stock market right now still has a little bit of disconnect with companies and what's going on. But what we're seeing is, just in these unprecedented times, we're seeing massive amounts of government intervention. And so as the government has stepped in and the Fed has stepped in on the Treasury Department by essentially pumping money into the economy, pumping money into companies with the unemployment benefits, with buying bonds in the fixed income world, even buying some stock in the equity world, we're seeing that excess cash flow being infused in the market. And so it's actually created this prop up in the stock market that otherwise wouldn't be there. So when you kind of have the big brother mentality, investors generally are much more comfortable saying, hey, I'm okay investing in a company that has the potential to be bankrupt or even has the potential to see long-term financial downside effects. And so they're a little bit more comfortable. They're willing to invest. We're seeing that the market rebounded a little faster than we otherwise would have because of that. But again, those benefits are running out. That money is running out. So I think many investors are looking now back to the government to say, what's the next step? What's the next capital infusion that you're going to give the economy?
Great. Thanks, Matt. So what does all this mean when it comes to your financial plans and retirement goals? We'll have some answers when we come back. Stay with us.
went with Schul Fence because we've used them in the past and we were very satisfied with their work. Their crews have been very good, and they did the work in 2 days. I said before, they've done work for us in the past in another location, and we were very pleased with it. Different kind of fence, but it lasted very well. And we wanted something so our backyard was more private. When we're done with our building, we're going to have them return and do a little bit more for us. Yes, if anyone out there is on the fence about who they would like to have do their work, I would say really consider Schul Fence. They did a very good job.
BNI, or Business Network International, is a huge organization, and today we're in 75 different countries with over 9,000 chapters and 260,000 members, almost 250,000. What it does, it gives a platform for a business owner to generate business for their company. That's really the sole purpose of BNI. So we would invite you to visit a chapter sometime and see if it works for you. If it doesn't, that's fine. What's the worst thing that can happen? You met 30 people you didn't know before.
Welcome back to Your Wealth Health. I'm Erik Brenner. Thanks for joining me today. And with me I have Matt Aurenz, a private wealth advisor and our director of wealth management at the firm. And we have been talking about the economy and the markets. And one thing we talked about at the break, Matt, is also football is in question for the fall. So that's another big one, as well as other sports. We just don't know what's going to happen with those. Before we roll into the next thing, I want you to think about this. If I were to offer up to you to say, look, I have an investment that could earn on an average of just under 10%. But with that, there would be 27% of the time you would not make money. 73% of the time you would make money. Would you take that investment? Would you consider that investment? Well, that investment happens to be the S&P 500. In 94 years of history, the S&P 500 has been down 27% of the time. The rest of the time it actually has been up, and it's averaged just under 10%. And Matt and I often say that our job would get a lot easier if folks could take the risk, because with 94 years of history, you just put your money in the S&P 500 and not pay attention to it. But Matt, that's not the case. So we know that risk is a factor, and it's especially a factor as you enter into retirement. So let's talk about this. Right now, do people need to re-examine their goals?
I think so. I think people need to, number one, determine what their goals are and actually put a monetary number around it and actually put a timeline on it. I think oftentimes when people have goals, it's just kind of this forward thought, this future out there thing that they're thinking about. And they maybe plan for it a little bit, but a lot of times we see people just make decisions without actually properly planning for it. So they jump into the financial decision and then they kind of think, I'll worry about it later. Well, there's not really time for that in these types of environments that we're experiencing now. And so forward planning is going to be paramount.
So Matt, also in decision making, we find in the work we do that oftentimes emotions come into play. Certainly that has happened here over the last many months. And, not knowing really the future and when we will get a vaccine and kind of get back to a normal life. So we just want people to be cautious on letting emotions kind of run their financial plan.
That's exactly right. Emotional investing is one of the things that we're experiencing more and more today, and we're talking about a lot more. And not being influenced by your emotions, looking at historical data, understanding how investments work, understanding how risk works, all of that is calculable. So we want to take the time to figure out how all of those work and what those pieces look like in your financial puzzle, and really plan for it.
So Matt, we talk about a lot, and we've talked about on the show before, this buckets of control. And so you'll see on the screen what we call 3 buckets. And the first one, Matt, is the let it go bucket. And boy, this has really been challenged, certainly over the last several months. This is not a new concept. This has been around for many years. But I think you can get infused with too much negative news, don't you think?
Definitely too much negative news and too much uncertainty and the what if game and not knowing things like what's going on with the disease, what's going on with the economy, what's going on with my career. So spending too much time in that bucket just creates a worrisome environment for you.
So then the second bucket you'll see is some influence. So you have some influence over your decisions. You can certainly vote and have some influence there, as well as other opportunities. So people need to influence the things they can influence.
Right, exactly. So if you can't control it, but you have influence, those are the things that you need to worry about. Those are the things that you need to put your time and energy in. And so again, to your point, Erik, governance is a big one, right? Getting out and voting, making sure that the people that you're voting for are helping solve goals, not just talking about them.
So then the last bucket is what you can control. One is your health habits, obviously, to stay healthy. Your investment choices. So, you can control how you invest, the type of investments that you have. You can control your goals. What are your goals? What do you want to achieve, as well as your spending? In fact, the spending's kind of interesting because, Matt, I know that we have talked about our interaction with clients, and people just are not obviously traveling. And so we hear over and over again that, well, I'm not spending a lot of money. And so control it is really important, what you can control.
Yeah, I think that's probably one of the biggest things, Erik, especially when we're talking about people who are laid off, people who are unemployed at this point, or people who even are employed. Just because you have a job obviously doesn't mean it's always going to be secure, as we've seen over the last several months. And so just controlling those dollar amounts, am I spending money on something that's going to help better my financial situation is really going to be a big key factor for many people over the next several years.
So Matt, this emotion and controlling your emotions certainly played out, I'm sure, for folks back in March, where we saw this pandemic really get a lot of steam and the markets changed in very few days. And what happens when someone makes a decision based on emotion and, let's just say, sells all their investments and wants to sit in cash?
Well, I think what they're losing is the opportunity for their investments to grow. I think what we looked at was, March 23rd was the bottom of the market, and we saw people selling their investments out of emotion, out of fear, and some of it justified, not knowing if the investments were going to continue to decline. And so they thought, well, I'll just sell out and go to cash. And with cash rates at historic lows, you're getting 0.01% return on your cash asset. You're not going to achieve your goals that way. You're not going to attain the long-term growth and investment return that you need. And so when you emotionally sell, then you have to look at that buying in opportunity. When do I buy back in? Well, if you sold on March 23rd, you sold at the low point, and the market's done nothing but recover since then. And so even if you would have bought in a month later, you still missed out on significant market recovery. And so as we see people make those decisions, we just question, why are you making that decision? Is it because you're unaware of the risks that you're taking in your portfolio? Do you understand how your investment is working? So a lot of it, I think, stems from just comfort in understanding my risk tolerance, comfort in understanding how my investments work, and making sure that those pieces, when I understand it all, it's helping me with my forward goal investment strategy.
Thanks, Matt. And then people really, we're not saying really that you need to take too much risk. We're just saying to have an understanding of your risk.
I would agree. Yep, you really just need to understand it. Risk is something that you can calculate, and so that's really what we do on a daily basis. Is we research the investments, calculate the risk as best as possible, and come up with a probability of success.
Yeah, and it's really a challenge right now because, as you mentioned, Matt, cash just doesn't pay anything, and it's not going to pay for a long time. So that's a really challenge. You need to earn some return, but what do you do? Another important issue for people is to consider their risk tolerance, their personal risk tolerance. How much loss can you tolerate during a down market, even when you know it will always come back? We'll show you some specifics when we come back on Your Wealth Health. Welcome back. We've been talking about our uncertain economy and the impact on people's personal financial planning and retirement planning. Understanding your risk tolerance is a big part of the decision. So Matt, we just think that people really need to get an understanding of their risk tolerance. And many people will say, well, I feel like I'm moderate, or I'm moderate aggressive, or I'm conservative. But we don't believe that's enough, do we?
No, not at all. You know, that maybe helps us get a start. But what we find is that, you know, walking through a good risk assessment is really going to be helpful. And you're going to have different risk tolerances or different risk assessments for various goals that you have throughout your life.
Yeah, and so we have many tools that we utilize to assist us, to give us good information, to give good advice. And so what you'll see on the screen here is a risk assessment tool that we use with clients, and it really breaks down their entire investment situation and how they look at risk, Matt.
Correct. So basically what you would find is that each investment that you have has an associated risk number, and we kind of think of it like a speed limit from 1 to 99. So the higher the number, the faster you're going, the more aggressive that investment is. And so when you break down those individual investments, they all funnel up to an account level risk number, and then those specific account numbers all funnel up to an overall risk number. And so, you know, you could have a college plan that's 15 years out that might be a little bit more aggressive early on, and you see that risk number back down as you get closer to college age. Same with your retirement plans, same with a goal to save for a house or a car.
So Matt, there's red and green on there. What does that refer to?
So the red and green is really, it's a helpful tool for us to help you determine the probability of your investment range. And so if you have a target of, for example, of a 6 or 7% return, what we can determine is what's the probability that your investment portfolio is going to fall within an upside and a downside range. And so if your downside range, for example, is 10%, what we're saying is if we can determine that in a 95% probability your investment return will go as low as 10% in any given year, but that's the worst it will be, we can actually determine, can you stomach that? So if your account is down 5% and you're ready to make an emotional investment decision that doesn't align with your investment objectives, we would then suggest, well, maybe you're not comfortable with that appetite for risk.
So Matt, what we do then is, just to break it down, we talk about each account, IRA account, Roth IRA, 401k, and so forth. Take a look at your personal risk analysis, get a number, and then we do some stress testing against that, don't we?
Right, exactly. And so what we can do is we can use historical data that says if your account and you were comfortable with this risk number, what would your account have done back in 2007 to 2009 in the financial collapse? Or what would it have done in the tech bubble? What would it have done back in the 87 market crash? And so we can actually determine, does that comfort level that you have with your portfolio, if it would have done this back in 2008, would you be comfortable with that investment? Or would you say, no, I'm not comfortable with that, and we really need to assess your risk again?
So Matt, with that, I find it important that almost everybody would take the upside, right? So they would take the upside in the portfolio, but assessing that downside and how far down, especially as we get into retirement in the distribution years, that's really important, isn't it?
It's extremely important. Understanding, in an accumulation phase, it's much easier to go with the ebb and flows and the ride of the market. But when you get into a retirement phase, if your portfolio is positioned for that you could experience a 40% downside, would you be comfortable with that in retirement? Odds are the answer is no. And so we just need to assess that risk and make sure that we find an investment strategy that is appropriate for you.
So with everything that's been going on over the last few months, we've had a lot of clients certainly want to reassess the risk. Conversations that we've been having with clients are, yes, they're nervous. It's maybe they're taking too much risk. Maybe, some people are saying maybe you take a little bit more risk because they see more opportunity, but it really depends on their personal risk. So we want to tie in your goals with your risk. and determine how much risk do you really need to take. So as you'll see on the screen, we can actually take a situation through the analysis that we've done and the risk assessment, Matt, and help people determine if they reduce their risk, then this is the probability of the return that they will receive.
Right, exactly. We can determine the probability of the return that you would receive. We can then tie that return to the goals that you have to determine will you be on track or not on track to achieve that goal. So it might be prolonging the goal, it might be saving more for the goal, and sometimes we find that people are taking on unnecessary risks. So they're actually on track to achieve their goal, but they just have more risk in the portfolio than they need. And so we would say, don't take the risk, back it down, and smoothen out the ride. The other thing that this tool helps us determine is things like what's the projected dividends off the portfolio, and it also helps us determine what are the costs in your portfolio. Is your investment return being eaten up by unnecessary fees and high expenses in the accounts that actually just deteriorate your investment return on an annual basis?
Yeah, that's a great point, Matt. I often say that there are very few things you can kind of control in the market and investments. I mean, you can have a good portfolio, solid balance in the portfolio, and you can align your risk, but you can control the cost. Costs are a factor, and we're not saying that you want to have the lowest cost necessarily, but you want to have an understanding of the cost, and that also factors it in. So you'll see this tool that we utilize with our clients, and it really does help us make good financial decisions with a situation. And this tool is an assessment tool, and you need to tie it into your goals. On our website, hilltopwealthsolutions.com, we've got a lot of great information, including you too can take your risk assessment. So you can access that on there and assess where you're at from a risk perspective. I also want to point out a couple things on the website that are of importance. First, you can schedule a free 30-minute call where this is an introductory call. You'll meet with an advisor and we'll determine kind of your goals, and you'll find out more about us. Secondly is we have some great resource and guides and resources. We have some checklists on there that will help you if you're in stages of life. 5 years till retirement, 1 year until retirement. What should you do about Social Security filing, just to name a few. And we're consistently updating those with information. So those are guides for you that I would encourage you to check out. Well, we're out of time for this episode of Your Wealth Health. I want to thank you for joining us. And for Matt Aurenz and the entire Hilltop Wealth Solutions team, we'll see you next week.